Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dover Corporation Annual Report. Dover Corporation offers a diverse range of businesses and services worldwide. At the core of its operations are two main segments: engineered products and clean energy and fueling. The engineered products segment provides equipment, components, software, solutions, and support services for various industries such as vehicle aftermarket, aerospace and defense, industrial winch and hoist, and fluid dispensing. This segment offers a wide array of products including software solutions for light and heavy-duty vehicle lifts, wheel service equipment, vehicle diagnostics, and collision repair solutions. It also provides winches, hoists, bearings, drives, electric monitoring systems, radio frequency and microwave filters, signal intelligence solutions, soldering solutions, and fluid dispensing solutions. In addition to engineered products, Dover's Clean Energy and Fueling segment offers components, equipment, and software solutions for the safe storage and transport of fuel, cryogenic gases, and hazardous fluids. This segment also provides solutions for the operation of retail fueling and vehicle wash establishments. The company's Imaging and Identification segment focuses on precision marking and coding, product traceability equipment, brand protection, and digital textile printing equipment and solutions. Its Pumps and Process Solutions segment manufactures specialty pumps, connectors, flow meters, fluid connecting solutions, plastics and polymer processing equipment, and engineered components for rotating and reciprocating machines. Lastly, Dover's Climate and Sustainability Technologies segment produces refrigeration systems, display cases, commercial glass refrigerator and freezer doors, and brazed plate heat exchangers for industrial heating and cooling applications. Dover Corporation's stock price has experienced a notable increase of approximately 11.78% to 13.96% over the past year, with some reports indicating a return of around 14.06%. Several key events have contributed to this growth. One significant factor is Dover's strong fourth quarter and full year 2025 financial results, which were announced on January 29, 2026. The company reported a 5% organic revenue growth and a 10% increase in bookings for the quarter, with adjusted earnings per share, EPS, rising by 14% year-over-year to $9.61. Management also provided robust adjusted EPS guidance for 2026, projecting double-digit growth at the midpoint. In addition to these financial results, Dover Corporation has received positive analyst ratings and price target adjustments. In February 2026, several brokerages updated their coverage of the company, with some raising their price targets. For example, Robert W. Baird set a $255 target price on January 30, while Seaport Research raised its price target to $245 on February 3. Furthermore, Dover's consistent history of increasing its dividend has also contributed to the stock's growth. On February 12, 2026, the company declared a regular quarterly cash dividend of $0.52 per share, payable on March 13, 2026, to shareholders of record as of February 27, 2026. This move is part of Dover's long-standing tradition of raising its dividend for 70 consecutive years. Overall, while the stock saw a slight dip following the Q4 2025 earnings report, the positive financial performance, optimistic guidance, and favorable analyst sentiment have likely fueled the broader increase in Dover Corp's stock price over the past year. Dover Corporation market capitalization of $32 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Dover Corporation holds a significant advantage in their industry. Dover Corporation trades at a higher price-to-earnings ratio of 29 times and a similar price-to-book ratio of 4.25 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. the company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the growth side, acquisitions and increased sales revenue have been significant contributors. The strong demand for low GWP, see Otwo refrigerant systems, and improving demand across various applications, such as beverage can making and heat exchanger applications, have also driven revenue growth. In contrast, revenue decline has been influenced by the disposition of businesses, project timing in retail refrigeration door cases and services, and higher capital expenditures. Additionally, segment-specific drivers have played a crucial role in shaping revenue performance. For instance, the engineered products segment has seen growth in vehicle aftermarket and industrial winch and hoist markets, while the clean energy and fueling segment has experienced growth in traditional and clean fuels. However, not all segments have been equally successful. The pumps and process solutions segment has faced decline due to diversified industrial manufacturing applications, while the imaging and identification segment's performance is unclear due to a lack of data. Overall, understanding these drivers is essential for identifying areas of strength and weakness and making informed decisions about future growth strategies. Net income decline, a shift in profit margins. The net income of a company underwent a significant decline, decreasing by 59.4% from $1.6 billion to $1.1 billion between two consecutive years. This substantial drop is also reflected in the change from $2,697,126,000 in 2024 to $1,093,956,000 in 2025. The decrease in net income suggests a shift in profit margins. Initially, it appears that profit margins increased, with gross profit margin rising by 160 basis points to 39.8%. Additionally, operating earnings as a percentage of revenue increased by 13.8%. However, the large decline in net income from 2024 to 2025 indicates that profit margins may have decreased significantly. The sale of the Environmental Solutions Group (ESG) business in 2024 and its classification as discontinued operations could be a contributing factor to the decrease in net income. This transaction might have had a substantial impact on the company's financials, leading to the observed decline in net income. The company's financial performance is a notable aspect of its overall health. A review of the operating cash flow reveals a positive trend. In 2025, the company generated $1,338,005,000 in operating cash flow, marking an increase of $250.2 million compared to the previous year. This upward trajectory is consistent with the data from earlier years as well. For instance, in 2023, the company's net cash provided by operating activities was $1,219,546. The steady growth in operating cash flow indicates that the company is effectively managing its operations and generating sufficient funds to meet its financial obligations. The increase in operating cash flow can be attributed to various factors such as improved efficiency, increased revenue, or better management of working capital. Whatever the reason, it is clear that the company's efforts are yielding positive results. The generation of positive operating cash flow is a significant achievement and a testament to the company's financial stability. The data suggests that the company is on a solid footing financially, with its operating cash flow continuing to rise year over year. This trend bodes well for the company's future prospects and provides a strong foundation for further growth and development. The company's debt level has experienced fluctuations over the years. According to the extracted summaries, long-term debt increased by €550 million in 2025, while total debt rose from $2,929,402 to $3,327,972. However, net long-term debt only increased by $91,949 from 2024 to 2025, indicating a relatively modest increase in overall debt. On the other hand, interest expenses have seen significant decreases. Interest expense net decreased by $57.3 million, 60.9%, to $36.7 million, and interest expense dropped from $131,171 in 2024 to $109,772 in 2025. These reductions suggest that the company has made efforts to manage its debt burden and reduce its interest expenses. Management is optimistic about the company's outlook for 2026, expecting improvements in organic growth trends driven by favorable demand trends across major end markets. The company has made significant investments in acquisitions, with 4 deals totaling $665.3 million to drive growth and expansion. Additionally, capital expenditures will increase to support new product launches and growth initiatives. Management is also focused on managing the company's capital structure to support future growth, with a net debt-to-net capitalization ratio of 18.2% at December 31, 2025. The company has adequate liquidity to meet anticipated funding needs, with operating cash flow and access to capital markets expected to satisfy various cash flow requirements. Overall, the company appears to be well-positioned for growth in 2026, driven by a combination of organic growth trends, strategic acquisitions, and investments in new product launches. Management's focus on managing the company's capital structure will also help support future growth initiatives. The company has made significant investments through acquisitions over the past 3 years, totaling approximately $1.9 billion. This includes 14 businesses acquired between 2023 and 2025. Additionally, 4 business acquisitions were made for a total of $665.3 million, taking into account cash acquired and contingent considerations. On the other hand, the company has also divested certain businesses due to changes in market outlook, financial performance, and value creation potential. This move resulted in a decline of 0.7% in consolidated revenue. The company has a long history of rewarding its shareholders through dividend payments and share buybacks. For over 7 decades, the company has consistently returned cash to its investors by paying dividends, demonstrating its commitment to shareholder value creation. In recent years, this trend continued with the payment of $283 million in dividend payments in 2025. In addition to dividend payments, the company has also been actively buying back shares as part of its capital allocation strategy. Through a standing share repurchase authorization and an accelerated share repurchase agreement (ASR) program, the company repurchased $500 million in shares in 2025 alone. Furthermore, the company has utilized commercial paper borrowings or credit facilities to repurchase common stock for general corporate purposes. These actions demonstrate the company's confidence in its financial position and its commitment to maximizing shareholder value through share buybacks. Concerns about supply chain disruption and inventory buildup are mounting. Supply chain constraints, labor shortages, and inflation in material input costs and freight logistics pose significant risks. Page 2. Transportation delays and interruptions, materials scarcity, and the impact of losing a single-source manufacturing facility also threaten to disrupt supply chains. Pages 18-21. Furthermore, the potential for raw materials price increases due to factors such as freight costs, transportation availability, and general economic conditions is a concern. The difficulty in predicting the effects of extended lead times or shortages on raw material supplies adds to the uncertainty. In terms of inventory buildup, the data shows a significant increase in total inventories from 2024 to 2025, with an increase of $127,946, page 70. Raw materials and finished goods inventories also saw increases of $115,460 and $31,604 respectively. This suggests that companies are stockpiling inventory due to concerns about supply chain disruptions, which could lead to further costs and inefficiencies if not managed properly. That concludes the financial summary for Dover Corporation. Feel free to comment below, and I will be happy to answer them when possible.